comments earlier and thoughts on, our thoughts and prayers with everyone that's involved in the conflict. There's really no winners from this situation. It's very, very sad. So I'm not an expert on politics, but what I am an expert on is market investment markets, and that's what I'm going to focus on today. So just going through the slides. As Stuart said, we'll go through the impact that this is having on different markets. There's always a tendency just to think about the equity market, but there's some big volatility going into commodity markets at the moment. And there's also been a big impact on interest rate expectations, inflation, and that has a knock-on impact onto government bonds. We'll touch on how the S&P has performed during different geopolitical events. We picked the S&P because it's got the longest track record and we can do this analysis, so that's the rationale for that. And sadly, we have seen wars in the past, and we can get data in terms of how different asset classes perform during that time period, both before and after. As Stuart said, what we're going through at the moment is short-term volatility and unrest. Importantly, when we go through times like this, and it's not just periods of war, but it's also significant changes that we've gone through over the last few years with COVID, for example, just highlights the importance of trying to look through the shorter term and concentrate on your long-term objectives as well. And importantly, Luna, other discretionary managers, we're not going to be focusing on what we do today too much, but we manage diversified portfolios across different asset classes. So we'll just touch on what we do, but equally that can be said for the market as well. So the first thing I'm going to touch on is not the equity market, it's actually going to be commodity markets. Commodity markets this week are set for their biggest rise on record. And this is why. On the left-hand side, you can see the exports from Russia and the percentage that it has from the economy. And then on the right-hand side, you can see that the impact that this has had on different, two oil prices here, both WTI, West Texas, and Brent. So you can see the impact that this conflict has had on the oil market, particularly. That being said, this is being felt through all commodities. Gold is seen as a safe haven, and investors have flocked to gold during this time. But other commodities like wheat, etc., are performing very strongly as well. Now, this slide is also important because it highlights, what could happen in the future. And at the moment, there's been a lot of words around banning exports or Western nations not buying from Russia. But this also shows the other side. Will Russia restrict its output and distribution to Western nations? And if there's 37% of their exports are from oil, it's very unlikely that they'll stop exporting oil full stop. And on the flip side, from a Western nation's perspective, Russia is the second biggest producer of oil that's exported. So there's a very limited desire at the moment from Western nations to stop buying oil full stop. What you can see, and we've already had natural gas prices at all-time highs before this happened, but you can see that the impact that this has on natural gas, and it's not a big proportion of exports from Russia. So that's more likely to see that there could be a ban from there. We've already seen the new pipeline stopped and not approved going forward anyway. So there's potential for the natural gas to be more impacted, and that's why the natural gas prices has been pushing to highs. Now, I'm just going to stop talking about commodities for a little bit, and I'm going to talk about different asset classes. So let's start with the equity market now. It's all really dependent on location. The closer you are to the conflict, then the bigger the falls that have been. And you don't necessarily have to be invested in the Russian stock market to have seen big falls. There's a couple of Russian listed miners, which is Evraz and Polymetal, which are listed in the FTSE 100. And both of those two companies have fallen by 90%. So you can see that the impact on these businesses has been pretty significant in a very short period of time. There's a Russian investment trust, which is listed on the London Stock Exchange. That's fallen by a staggering 85%. So you can see that the impact on Russian securities has been pretty significant. But thought the important point here is they are 2 or 3 holdings within the FTSE All Share. We at Luna have never bought any of these products. We don't tend to buy regional specific products full stop. And equally, Russia is a very small allocation in most global stock markets. So if you think about the MSCI emerging markets, which is the core emerging market index, there's only 3% allocated to Russia. So it's very small. It's having a very small impact on global stock markets from that perspective. That being said, there is a tendency when events go through this for risk aversion, and as Stuart touched on, increased volatility. And that's exactly what you've seen. And Europe has been more impacted by that, as I said, because of the location. So European stock markets have fallen more. The UK being a European stock market, whereas the US and the S&P 500 has been broadly unchanged so far since the conflict began a couple of weeks ago. So it really depends on the different types of asset classes. Now, just going back to commodities briefly, and that's an important point with regards to inflation. We're already at eye-watering inflation in the UK anyway, in 30-year highs. So currently, consumer price inflation is at 5.5% in January. Retail price inflation was just under 8%. And this is before all of this conflict started. And it was expected that inflation was going to be picking up over the next few months anyway. I don't know if anyone else has been getting emails from British Gas or their gas or electric provider recently, but I did, and mine said my prices are going up by 50% in April. And that's going to be impacting CPI from then on. So the Bank of England had forecast that CPI was going to hit 7% before this had happened. It's very possible that inflation could get to 8 or even maybe 9%, which is unheard of over the last 40 odd years. You have to go back to the early 90s, late 80s since we saw that type of inflation. So that has an impact, and markets are also, stock markets that is, are being a bit more volatile today because of that, because that is a tax on consumption. If costs are going up, then that means we have less money in our pockets to go out and spend. And most developed markets are consumption-based economies, so it's not a good outcome for growth, and it's not a good outcome for stock markets, and that's why stock markets have been a little bit weaker more recently. That being said, it's not been a negative for every asset class, despite the fact that inflation is expected to be moving higher. The expectation for interest rates, which had been the predominant driver of market performance this year, has actually come down. And that's because central banks are now focusing on the fact that growth will be low in developed markets. The Fed chairman spoke a couple of days ago and said that interest rates won't be going up as fast as people maybe expected a month or so ago. So what you've seen is bond prices rise, bond yields fall because they have an inverse relationship. So that's actually been a positive from a bond market perspective over recent months. Currencies, the ruble fell by 30% on Monday relative to the dollar. Other currencies have been affected by this. You tend to see safe haven currencies like the dollar and the yen perform slightly better in this environment. So that's what's happening, but sadly, we can go back to history and see what's happened in the past when we've had different geopolitical events and the impact that they've had on markets. And here, this just touches, as I said, on the S&P 500, the one-day move when the announcement came through, the drawdown from peak to trough, how long that took, and most importantly, how long it took to recover. So as you can see in this chart, the average fall when an event like this happens is about 1.5% on the FTSE, on the S&P 500. And stock markets tend to fall by about 6% from peak to trough. That being said, you can see that no event is created equal, and some have a bigger and less impact on markets. The average day to get to a market bottom is about 15 days. We're currently 2 weeks into this, so we're bang on average now in terms of that. And you can see that it normally takes just over a month for the stock market to recover from that. I think there's an important point to make here that markets had already been moving in anticipation of this in January and February. The S&P 500 is down 8 or 9% year to date. And that's a function of the fact that In January, investors were worried about inflation. They were worried that interest rates were going to be moving up significantly higher. That impacted technology and growth-orientated companies quite significantly. But also this Russia and Ukraine conflict was rumbling on in the background and clearly has escalated quite significantly in February. So markets move in anticipation of events. I think the best way I can highlight this is if you think back only to 2 years ago, on the 23rd of March, it was actually the stock market low on the FTSE 100. That was also the day that Boris Johnson told us that we were going into a national lockdown for the first time. So the stock market bottomed on the day that you thought the news would be worse. And that's because markets are moving in anticipation of events and seeing through this. So despite the fact that this feels very dark at the moment, I'm not saying this is the low of stock markets now, but we could be very close to it at some point because markets move anticipation of events and we know the certainty of the event now. Again, we can look here at the performance of, again, US asset classes across different time periods. So on the left-hand chart, you've got the different events that have happened. Next to that, you can see how stock markets have performed, large cap S&P 500, how smaller companies perform in this environment, bonds and inflation. So I'm just going to pick on just two numbers. The average return from investing in markets and in large cap companies is 10%. But interestingly, the return, annualized return, increases in periods of war to 11.4%. And equally, volatility falls. The risk of investing actually falls when you're going through wartime. So the risk falls from 19% to 12.8%. And again, that's a function of what I said earlier in terms of markets actually move in anticipation and before the event. And then when you're in the event, they tend to rally and perform stronger. Now, at the moment, we're still in the eye of the storm and things could get worse before they get better. And if this escalates, the markets could fall further. But that being said, the longer term picture suggests that this could be a positive environment for being invested. You can see the impact on different other asset classes. And we touched on inflation before. You can see that inflation does tend to pick up in this environment because of supply chain issues and because of the conflict that's going on and the impact that has. We've touched already about the importance of longer term investing, and that's what we concentrate here, and that's what you should concentrate on as well in terms of your investment goals. And this is a very important chart to show this. So this is returns, annualized returns from investing in the FTSE All Share over the long term. And you can see on the left-hand side, if you remain fully invested for the whole time, you generate a return of 7.23% per annum. If you miss out on the best 10 days of stock markets, that return falls to 3%. And it's because the compounding impact of those good days has over a long period of time, as well as the fact that you're getting dividends reinvested. But look what happens if you go all the way to the right-hand side. Just 40 days, you miss 40 days over this time period, then you actually deliver a negative return of 3.5%. Now, we are seeing some steep falls in markets at the moment, but we are also seeing some very strong days as well. Thursday last week, we saw a 4% fall in the market, and it was headline news. The following day, stock markets increased by 4%, and nobody talked about it. So there is a tendency to focus in on the bad news, and when you're having a bad day in stock markets, what I'd say is those tend to be followed by the good days as well. So despite the fact we're having some large falls at the moment, it's very likely over the coming weeks and months that we'll also see some large increases on daily performance as well. And you really don't want to be disinvesting at the moment to miss out on those, because it can have a long-term impact on your returns. When building portfolios, not just at Luna, but across the wealth management industry, it's incredibly important to remain diversified. The old saying, don't have all your eggs in one basket, that's incredibly important for managing risk in this environment. And the first way that we do this is by asset allocation. It's having money in bonds, so bonds perform well in this type of environment. It's being invested across different equity markets. You can see there that emerging market equities is a very low allocation for Luna, but equally across the industry. And as I said, Russia within that is an even smaller part of that allocation. But it's having exposure to gold miners, which will do well in this environment. Technology and cybersecurity companies have actually done quite well in this environment as well. We also would always have some defensive alternative assets within the portfolio to provide that support during times of stress. And that's really been key this year in terms of helping performance as well. And then we touched on cash. If you've tuned in the past, it's very difficult to justify holding cash when it's yielding 0.5% if you're in the UK. And as I said, if inflation gets to 7 or 8%, then in real terms, that's a big impact on your long-term value of your portfolio. So that was all I wanted to go through today. Hopefully that gives you a good understanding of, one, how markets have been impacted in the short term, but two, really it's important to be focusing on longer term goals and objectives at this time. Don't get too focused on what's going on in the short term and the volatility that's going on in markets, and be well diversified in the portfolios that you have.